and welcome back to the Wall Facer podcast. Today's guest is Nik Kunkel, the founder and CEO of Chronicle Labs. Nik is a longtime contributor to MakerDAO and an early builder in the Oracle space. His company, Chronicle Labs, just recently raised a $12 million round of funding led by Strove Ventures with participation from Brevin Howard and more. Nik, welcome to the show.
Awesome. Thanks, Ryan, for having me.
My pleasure. So as I was doing a bit of prep for the podcast, I was looking into your background, and I was surprised to learn actually that you started your career at IBM Research working on Hyperledger, and then of course went on to be a longtime contributor at MakerDAO. Those feel like two very different ends of the crypto spectrum there. So I'm curious how you first started working on Hyperledger and then eventually made your way to Maker.
Yeah, that goes back a long ways. I think like IBM at the time was, they're still struggling, but they were struggling with the onset of cloud, and they were getting outcompeted by Microsoft Azure, Google Cloud, AWS, and so their kind of corporate philosophy was the next big thing that comes, like we're all in. And so they were actually, to their credit, extremely early on the blockchain train. Their kind of only vice was that they were steadfast on permission chains, right, rather than public. And at the time, right, there weren't really public smart contracts platforms. This was kind of like before Ethereum went live. And actually, like when the Ethereum white paper came out, it kind of caused some waves where we were kind of telling our bosses and our directors, right, like, we're thinking about this all wrong. It's actually like public chain. And like, we were just kind of told to shut up. And eventually Ethereum mainnet actually launches, and again, we're just like, no, like it's not vaporware, it's real, like it's happening, right? And like it became very clear that they just didn't get it. So I left and went into this Ethereum ecosystem hoping like, oh, I'm going to meet all these builders, and there were some, but much less than I thought. So I think at the time there were maybe like 4 projects that I think had a chance that were working on like a problem that I could foresee, being significant. So it was like Augur, like for prediction markets. It was like Digix DAO, like tokenized gold. It was Maker with a decentralized stablecoin, and like Golem with like decentralized compute. Those were like the 4 projects that I thought were working on like a real meaty problem that had promise. And I guess I got quite lucky that I ended up choosing Maker.
Yeah, it's interesting, actually. Just the common theme maybe through all of those projects is that they were maybe too early. Obviously, prediction markets today are huge. Digix DAO, I guess the idea of tokenizing assets more generally is obviously a big theme and something we'll talk about today as well. And then even Golem with the idea of decentralized compute. I kind of forget what the original Golem was, but today, at least with AI, the idea of having some sort of decentralized compute is at least a big theme. You certainly picked right out of the 4 of those in terms of who's still here today. So,
well, I mean, now Golem is just a tokenized hedge fund. Right?
Yeah, exactly. So when you joined Maker, that was what, early 2017?
Yeah, it was like December 2016, January 2017.
Wow. So if I'm correct, then Psy did not even launch for about a year after that, right? That was December 2017.
So
or 2018?
It depends on what you think of as Psy. So when multi-collateral DAI launched, we ended up rebranding the previous version, single collateral DAI as Psy. But the Psy moniker actually like predates that. Because in June of 2017, we released like a prototype of DAI, which was called Psy. And Psy didn't stand for single collateral DAI, it stood for like simple DAI. It was the simplest version of the protocol that we could construct that, would be a good prototype for kind of testing out different mechanisms and different assumptions. And that the key characteristic of Psy was that as soon as Psy was released, we all started getting paid in Psy immediately, right? So we were like dog fooding our own stablecoin and really doing like a what would you say, like a user testing product development based approach, because we were the first users. So we saw like what problems people would have, like being paid in a stable coin or redeeming their stable coin, trading it, right? And so I think that gave us a very interesting perspective.
What were some of those early challenges you ran into? I imagine, off-ramping and paying bills in the real world was a big one, but what else stands out there?
Exactly. Rent is due and your landlord doesn't accept stablecoins. But similarly, because your stablecoin is just a prototype, right? It's not listed on an exchange. DEXs at the time were very primitive. There was no Uniswap kind of bonding curve. There was just, you could post a specific order and someone might decide to fill that order, but there were no market makers, right? So you really had to like find your own counterparty, right? And then negotiate a price and
Yeah, nothing like taking a haircut on your dollar salary to be able to figure out how to off-ramp that somehow. But
sure.
actually,
Well, that highlighted a nice problem of redeemability, right?
Mhm.
And that problem was later solved with
Yes.
the kind of like swap facility with USDC.
Absolutely. And actually, while we're kind of going back through history here, I mean, even kind of Uniswap's initial growth and traction, if I'm remembering correctly, kind of came from people using it for swapping DAI and that just being a real major use case as well.
Yeah, no, there was definitely a very symbiotic effect, right? Because you don't borrow if you lock up some ETH and you borrow DAI, right? You're not going to hold on to that DAI, right? You're paying interest on it. Well, so the point was to either sell it into fiat, right, to finance whatever purchases you want to make, or what was the more popular use case, right, was getting leverage on the underlying ETH, right? And so all of that leverage was acquired through Uniswap, as you pointed out, right? So there was definitely a very symbiotic effect of that growth of the early like DAI stablecoin supply from people seeking leverage, and Uniswap having that corresponding like volume spike from all the counterparties taking the other side.
Right. So I'm curious, just also going back to those very early days at MakerDAO, I mean, what was it like? I mean, as you mentioned, there was no broader crypto ecosystem at that point. It was Maker and a few other small projects. And, maybe that was around the time like DYDX or something was getting started as well. But, what were those days like? Like, how big was that early team? I'd love to learn more about that too.
Sure, I would say it was quite challenging because we didn't have a lot of the infrastructure and services, I think, that have we now have today, right? That have grown to kind of solve these fundamental problems, right? So you don't have a Oracle provider that you can just go to. If you needed an Oracle, you had to make your own, right? And Oracles had been used in a hobby project kind of capacity, but not on the scale of 50, $100 million, right? And so when it comes time to put real money on the line, right, tinkering and research and prototyping isn't enough, right? And so you get to learn from the school of hard knocks. So I'll give you a fun example. Back then, the Ethereum gas price was 1 GWI. Never got even close to 2 GWI. And so in the Oracle update code, we had a hard circuit breaker cap at 10 GWI with a comment that said, clearly we will never like exceed this threshold. So if the program is telling you it's over 10, you should ignore it because that's a bug. Until one day, gas did go higher than 10, right? And all of a sudden, all the oracles just seized up and stopped updating, right? So yeah, I think that one's kind of fun, right? But even other things, right? Like RPC nodes. You had to run your own RPC node infrastructure, and it's not like Geth is today, where it's super super stable. These software stacks were incredibly immature. Like we had a script that would kill all of our RPC nodes once per day and then restart them because these things just had terrible memory leaks. Market making, right? There were no professional market makers and no one had even created a crypto market maker. So we had to create our own, right? Um, the dexes that were out there were very primitive. Like I said, someone had to post an order and then you could like manually fill that specific order. You couldn't even fill multiple orders at once. So we created the first dex with order matching, which was a big deal at the time.
Oasis Dex, if I remember correctly.
Oasis dex, exactly.
Yeah.
So, right, and back then it was called Maker Market.
Nice.
And even in the earliest iteration, it was called like simple market. So yeah, I mean, those early days were, I think, really fun, right? A lot of greenfield, but also just dealing with a lot of mundane problems that were not really the core thing that we wanted to solve, right? Which was stable coins and payments, right? There was it required a lot of work in a lot of other areas that, quite frankly, like we didn't want to do.
Well, I think it's a great testament to why today there is even the concept of a maker mafia, which is that anyone that was there in any of those early days, there was just so many hard problems that you had to do from the ground up, that it makes sense that today there's now I guess Oasis X has kind of become Summerfi. There's you guys, there's what Spark is becoming, all of these just different teams, and obviously all the people who've gone on to do things unrelated to Maker as well. Really just understanding the crypto ecosystem from a very, very deep level and all of the challenges that are out there. So
Yeah,
I'd love to use that
absolutely.
to actually segue a bit into what you guys are doing. And I guess for anyone who's not listening, which would be weird if they don't know what Chronicle is, but what is Chronicle Labs, Chronicle Protocol, and how did it come to be?
Sure. So Chronicle is the second largest Oracle protocol right now by total assets secured. We kind of spun out of the original MakerDAO oracles, which I co-designed, and really incorporating like a lot of those lessons that we learned back then. We essentially took my entire team with me from Maker, and we said, okay, we actually have like the ability to like start over and really like incorporate all those design elements and tweaks that were too radical to do if you were going to take an iterative approach, and was really only possible, right, if you started fresh. And I think we largely succeeded. I think kind of the ethos here is that although DeFi scaled incredibly quickly in a fairly decentralized manner, when you look at Maker, you look at Aave, you look at Compound, right? On the infrastructure side, and Oracles in particular, that decentralization and transparency was really lacking. And I think it's just a function of when an ecosystem is growing so quickly, right? The quickest and cheapest way to build something, right, is to make it centralized and kind of opaque, and it really requires an exorbitant amount more of energy, right, to make something like actually decentralized and transparent. And so the thinking is, right, that it doesn't matter if you have a decentralized like financial ecosystem if all the infrastructure it relies on is just completely centralized, right? We will always like mean revert to the lowest common denominator here. And so with Chronicle, really, that was the goal, right? How do we solve a lot of the problems that oracles have, but while maintaining that high degree of decentralization, right? And so I'll give you an example that I think cuts really well into the meat of the problem, instead of just touching on it in the abstract, is scalability. If you go back to 2021, we had like after DeFi summer and after Black Thursday, right? We had this very aggressive bull market in crypto, and gas prices spiked crazy high. And in that year, MakerDAO spent $6 million on gas just to update its oracles, which is an insane amount of money, right? Just to update a handful of oracles, right? And, fortunately, Maker was, making over $100 million in revenue in year at the time, right? And was very fortunate to be in that position. But, what is everyone else supposed to do, right? Who else can afford that, right? And so scalability was a really big problem for oracles. And the kind of trade-offs kind of go something like this. If you alone just kind of like update the oracle, and the oracle just updates to whatever you say it is, right? That is the most scalable oracle, right? Like, hey, oracle, here's this number, publish this number, right? That's the most scalability that you can achieve, but completely centralized, right? On the opposite end of the spectrum, you can have a bunch of validators, right? And they all reach a consensus, but this reaching of consensus is incredibly expensive to do computationally. And so you can update the oracle in a much more decentralized manner, right? Which is much more secure, but now it's really expensive, right? And so the optimization problem becomes, how do you update the oracle in a scalable but decentralized manner? And so what most oracles do is they just have each validator generate a signature, And then you have some number of validators, right, collaborate to reach a consensus. And the problem with this model is that, like, well, you want more validators to be more secure, more decentralized. But the more validators you have, the more signatures you need to verify. And that just makes the Oracle update more expensive. So there's this really kind of perverse moral hazard that you as an Oracle provider have, like in selecting, well, how many validators is enough, right? And your profit margin is determined by what is good enough security and how much can you charge a customer and what is kind of your cut that's left over there. And so we looked at that and we said, like, that's incredibly broken. And so what we kind of came up with is research that actually came from the Bitcoin side. You don't actually, hear innovation and Bitcoin, come up in the same sentence a lot. But Bitcoin actually pioneered the usage at a scale of billions of dollars, right, of a category of signatures called Schnorr signatures. And what these really are an ability to aggregate multiple signatures into a single signature. And so that's kind of how we were able to solve this problem, is while every other Oracle has this linear relationship of the number of validators to cost, we were able to decouple that entirely. And so we have like this constant verification cost of this single signature, but we can compress as many signatures, as many validator signatures as we want into that single signature. So, without calling out anyone in particular, it was between, I think, 3 to 12x more efficient than any of the other Oracle protocols on the market.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
Very interesting. So there's a few different directions I could go there, but I think you've given kind of a great overview of what you guys are doing. And you mentioned at the end there, just sort of where, from a technical perspective, I think you have a comparative advantage to other players in the market. I guess from the protocols or chains that are working with you guys, ingesting this information, like, is that then cost efficiency that gets passed through to their end users? Does it, decrease what they owe to an Oracle provider? I'd love to actually just dig into that kind of supply chain of people who, I guess you call them validators, like everything from kind of the validator to the end user, and how using Chronicle could impact that.
Okay. Well, I think that's a great way to go about breaking down the problem. So if we start at the validator level, I think this term validator is kind of like thrown out there, and it's like this abstract thing, and everyone's like, who is the validator, right? Or like, if I say miner, right? Like, you have like some silhouetted figure in a hoodie. No, but like the validators for Chronicle are all highly reputable entities in the crypto ecosystem. So just off the top of my head, and this is not a complete list, but we have entities like Gnosis, like Infura, Gitcoin, definitely Maker, and all sorts of others, right? I can actually look up a more complete list if you give me a second.
No, yeah, and I guess while you're looking for that too, also just what is a validator doing at a very specific level? What is the role of a validator?
So the validator solves what I would call data integrity problem and the censorship resistance problem. So the data integrity problem is, if I'm the only validator, I go look up a bunch of data and then I lie to you and tell you the data is something else, right? This is why you don't just want one validator. Okay, fine. You have 2 or 3. Okay, but now they can collude. And so the idea is that the more validators you involve, the less likely you're going to have these integrity issues where some subset of the validators can collude to manipulate the Oracle. Right. Now, censorship resistance is just, it's not that the validators are manipulating the data, it's just the validator stops reporting. And so you really don't want non-reputable entities or people to run these validators, right? The role they serve is incredibly important, right? You're placing the integrity of the Oracle is determined by who are these validators. And I think it's very telling that most Oracle protocols like either don't tell you who the validators are, and or it's buried somewhere very deep and it's not very in your face, right? Because it's not when you're thinking of who to entrust your finances with and all of your assets, right? It's not necessarily the who's who of people that you would choose. So I did actually pull up a list of who our validators are that's more complete, right? And we have teams like Nethermind, right, who have made one of the largest Ethereum clients. You have some L2s like Mantle, right? You have some DeFi protocols like Euler and DeFi Saver and Maker. We have ETH Global, who is one of the largest Ethereum events organizers since very, very early in Ethereum, right? They still run some of the biggest events of the year. You have people like Etherscan. You have more institutional entities like Bitcoin Suisse, who have very large amounts of crypto custody for their clients in Switzerland. So it's a very broad mix, but it's all entities, right, that aren't new and that have really been around for many years and established, right, a reputation of integrity and a reputation of trust. And you're not really trusting any of them individually, right? When you use a Chronicle Oracle, you're trusting the group consensus of all of these entities, right? And I think from a product perspective, we just want to keep adding more and more and more reputable validators, and the Oracle will just get more and more and more decentralized and secure.
Well, so in the case of someone like, let's take Euler, because that's a very specific protocol. Are they only reporting on data from the Euler ecosystem, or are they more broadly reporting on prices? And okay, I'd love to
They
dig
are
into that.
more broadly reporting on all of the assets that the Oracle supports. So I'll give you like an example. Let's take the MKR token. The MKR token, trades on Coinbase, right? Trades on Binance, right? It trades on Kraken, trades on all these centralized exchanges, but it also trades on, DEXs like Uniswap, for instance. And right. So what a validator is really doing is it's pulling this data itself from all of these both centralized and decentralized and sometimes hybrid sources, and then plugging all those data points into a model and basically calculating the kind of canonical value each individually. And then all of the validators kind of share and compare notes, and you kind of take the median of this quorum set of validators, right? And so all the outliers kind of get filtered out. All the malicious actors trying to manipulate the price get filtered out, right? And you take like this middle value, and that's how most oracles actually work.
Okay, so that is a piece of it that I am familiar with. So that's great to hear. So I mean, if it's useful, we can actually keep kind of walking through some of the supply chain, like where the apps or the chains then ingest some of this information, and even, I guess, frankly, how you find in those conversations that they're choosing which Oracle provider to work with.
So I can tell you, at least like from our perspective, right, how these conversations go is an Oracle is really, as a DeFi protocol, an Oracle is like the Achilles heel to your protocol, right? Let's use Maker as an example. If the Chronicle Oracle reports Ethereum has a price of 0, right? Every single Ethereum collateralized loan on the Maker protocol, right, gets liquidated at once. Similarly, let's say the ETH Oracle reports a value of 1 trillion. Well, then anyone can take like a very small amount of ETH and borrow way more DAI than the ETH is worth, and now the protocol becomes insolvent. Right. So the selection of an Oracle is like extremely non-trivial. You really want to not take any risks here. And I think that's where we kind of fit in very well, given that, we were the first Oracle on Ethereum. Like we even predate Chainlink. So we really have that Lindy track record, not just of duration of time, but also the billions in assets that we have secured on chain during that time period. I think at one point in 21, 22, we were securing over $20 billion in TVL, which was the majority of DeFi's TVL at the time. So we really have that kind of proven track record, and we've never had a hack or a misreporting in that respect.
Yeah, I mean, I think that is about the highest kind of level of testament that you can get to. And also, I do feel like the kind of Oracle as being this Achilles heel is maybe a bit underrated in the, stack of security. I think many of the larger, especially on kind of perpetual dexes, hacks that we've seen do tend to be these Oracle manipulations.
Yeah, absolutely. And there's kind of a lot of factors at play here. Certainly, a lot of exploits try to manipulate oracles in some way. In the past, we've seen some teams try to not use an external oracle provider and think that they can kind of roll their own, and then that would be safer in some capacity. I think for the most part, those people have a lot of egg on their face, and this is something that you should entrust to people who have spent years really thinking about this problem and studied all of the hacks and all of the ways that an oracle can possibly be manipulated. But you're right, it still happens today. And it's a very multifaceted problem, right? I can tell you kind of from an oracle perspective, right? From a provider perspective, how we look at this is the assets that are most likely to be manipulated are smaller assets that don't have much liquidity and aren't traded on very many venues. And, unfortunately, those are also a lot of the same potential clients that approach us, right? When think of the type of team that needs an oracle. Well, hey, we are about to launch our token, or we just launched our token, right? We have some liquidity on Uniswap, right? It's very low market cap, but the next step for us is to get integrated into a DeFi protocol. And so now we need an oracle. And, now it's up to us, right, to do the investigation of is it actually possible to create a safe oracle for an asset? Because an oracle doesn't do magic, right? If in terms of data, right? Garbage in, garbage out. So the oracle provider, I think, similarly has this moral hazard kind of scenario that, is constantly thrown at them, right? Where they have to kind of turn down business because, they think that, okay, this model is deeply flawed. There's not enough sources. There's not enough liquidity, right? They want the DeFi protocol to give up to $3 million of credit, right? But if you think of what even 500K of liquidity blowing through the order books would do on the kind of DEX venues that the thing is being traded on, right? It's just a disaster waiting to happen, right? And so um, there's a real kind of chicken and egg kind of problem there, where you really need this buildup of liquidity. You really need this liquidity to be across multiple sources, and teams are like, well, we want to do that, and that's why we need you to be integrated in this DeFi protocol so we can get more utility and build up that liquidity. So it's a very tricky position, both for new projects, right, that are really trying to find product market fit and gain that traction, but also from the oracle provider, right, that has to really kind of be this responsible arbiter of do we want growth, right, or do we want to be responsible?
Well, you raise an interesting point there, I guess, which is that you are just as much choosing the customers and clients that you work with as they are choosing an oracle provider to some extent. And it's kind of a nice segue into something I was curious about, which is I do actually think oracles are kind of complex to understand. And as I was trying to think about the best metrics for comparing, there's obviously total value secured or total assets secured, I think you mentioned earlier. And as I was looking at DeFi Llama, you guys are obviously second to Chainlink in total value secured. The other metric there is really, I guess, the number of protocols that are secured by a specific oracle provider. I guess, do you think that those are kind of the two most critical metrics, or how do you think about sort of the metrics that you guys are measuring against there?
So I think it's a bit of a flawed metric.
Many are. Many metrics are quite flawed.
Yep. I do understand why it's there. I think at a glance, it can give you a relative snapshot of how utilized an oracle is, but I don't think it really tells the whole story. One way to think about this might be how good a metric is. One way to think about that is how easy is it to manipulate? And it's relatively easy to manipulate. I'll give you an example. Take a new protocol right? They just mint a new token and they swapped one of those tokens on a DEX somewhere for, $1, and there's a billion tokens. Now we say this token has $1 billion market cap. We take that token, we put it in, a DEX, and now we provide liquidity, and only at that high price. And now we take another one of our tokens and we put it in a DeFi protocol and use that as collateral. And we say the Oracle is using the price of that DEX. And so now we have a DeFi protocol, right? And that has this token that accepts this token as collateral, and this token has a $1 billion market cap. I can now stuff all of our 1 billion tokens into the DeFi protocol. The DeFi protocol doesn't even need to let me borrow anything against it, right? It's just sitting there as TVL that's locked. And now that DeFi protocol is happy because they got 1 billion of TVL, right? The token project is happy because they get to probably convince someone to buy their token at some inflated value. And the Oracle provider is happy because they just got 1 billion of TVL, right? So it's incredibly flawed, like insofar as how it can be manipulated, but provided that it's curated in a reasonable manner, I think it can more or less give you a picture of kind of how utilized different oracles are, right? Like there's no question that Chainlink is, securing the most value in DeFi. But I think there's also no question that Chronicle is a very, very firm like runner-up in second.
Yeah, I guess it's one of those metrics that you do really have to dig into. You can't just take at the surface level. You have to dig into the actual protocols that are being secured. In your case, a Maker; in Chainlink's case, an Aave, and whatever else. But yes, absolutely. So it makes a lot of sense. So there is something about oracles that I am very confused by. And I think you are the expert on this topic, which is I don't understand the business model of oracles, really. It's, and that's really for all pieces of the stack. There is the oracle provider like yourself. There are the validators, and I'm not sure who's paying who. In my work, with working at DeFi protocols in the past, whenever we've used, at the time, Chainlink was kind of the option, but using Chainlink, we never paid them any money. They never particularly asked us for any money. So I never understood what the business is of these protocols. So I'd love for you to help me understand maybe generally across the industry, and then if there's anything specific that you guys are doing different.
So a bit of a thorny question, not
Good,
necessarily
good.
for us, but I think more like for our industry. I think the general practice of unsustainable business models is not exclusive to oracles. I think in crypto and even beyond crypto, right, we've seen many businesses just vying for growth and adoption and integration, right? And the costs are just bared by the investors that are funding the outfit, right? I think a good example of that is also, right, what we talked about earlier, right? This scalability problem that oracles have, right, where the costs can run up significantly, right? Like in the Maker example, right? They spent $6 million. Do you think any of the other hundreds of other DeFi entities in the industry were shouldering those costs? Absolutely not. Right. So yeah, I will accept that it's been slightly contentious, especially when, some teams are really trying to juice up their metrics, right, in the lead up to their token launch. But eventually, time catches up with you. You can't just, investors, start asking, are you monetized, right? What are your unit costs? Are you profitable, right? How much revenue are you generating? When are you going to be profitable? And now you actually have to figure out how to monetize something. I think in particular, and like being the most mature, I think when they calculated out how much they actually needed to charge people, they were like, oh gosh, no one is ever going to pay this. Right. Especially with your experience going from free to one day get a bill for, 10,000 plus a month. Right? It's not really viable, right, for a lot of startups, especially those that are tight on funding or are trying to allocate their funding more towards, paying their employees. So I think one leg of it is certainly from a computational basis, right? What we talked about earlier, and we've optimized that cost down to almost nothing. I'll give you an example. To do a Chronicle Oracle update on Ethereum mainnet today costs 52,000 gas. The default Ethereum transaction cost is 21,000 gas. So, we've really optimized it, down to down to the nails. An ERC20 transfer, that's around 100,000 gas, right? So we're about half the cost of an ERC20 transfer, right, to do an Oracle update. So that's one part of the equation. Well, what's next? Well, you still have to pay the validators, and validators are not a good Samaritan type of gesture. There are significant costs associated with running a validator, right? Because you have to have 100% uptime, right? So what kind of personnel and infrastructure systems you have to have in place, right? So you have 24/7 uptime, right? It's quite expensive. And so those costs are really, how do you make up for that as an Oracle provider? Well, you make up for it in scale, right? Without scale, the unit economics do not work out. Right. I think there are some interesting things in terms of pricing that have been tried as well. Like I think a lot of protocols have been trying to give their token utility by having you able to, redeem one of their tokens or however many, right, in order for access to read the Oracle. Well, if you're providing Oracle access to let's say, smaller DeFi protocol that has like 1 million TVL, are you providing as much? Is that the same as if you're providing an Oracle to a DeFi protocol that has 5 billion? Should those cost the same? One, should those cost the same? And two, um, what is the relative value that's being delivered there, right? And I think on that front, right, you do need to have like this pricing segregation, right? If you want to grow, you can't charge the small fish what you're charging the big fish, and if you want to be sustainable, you can't charge the big fish, what you're charging the small fish. So this bifurcation of cost relative to value being provided, I think is incredibly important in order to make things sustainable. Now, I think one good factor to look at there is kind of TVL, or in the tokenized asset equivalent, right? Assets under management. And I think there, like, if you think about it the way traditional finance thinks about these things, the crypto corollary makes much more sense. In traditional finance, fund managers are earning some kind of fee scaling with assets under management, right? Whatever it is, 50 bips, 25 bips, 100 bips. And every associated service provider is essentially just taking a sliver of that. And so this is a very natural business model, right? More assets under management scales into more fees, right? But the percentages remain fixed. Or maybe you have slightly different percentage tiers depending on what milestones you hit in kind of AUM, magnitude. Crypto should be doing the same. Crypto is no different in that respect, right? And we shouldn't keep trying to roll our own, right, when there are perfectly good existing business models and mechanisms that are already available to us that have been tried and tested that we should just pick up and use.
Okay. So I agree with that. I mean, I think what you're describing is something like an AUM fee, or similar to what I think people are familiar with the SaaS product, right? You start on a small plan, you grow, the amount you pay grows proportionally to the size of your offering or whatever it is. I guess though, my question is that actually how things work today? Your case or Chainlink's case, maybe let's take someone that's not you, Pith or Redstone or some of these smaller Oracle providers. Are they actually charging these type of fees, or is today mostly subsidy? Are the L2s paying to get Oracles on their chain?
Without calling out anyone in particular, it's hard for me to give you a definitive answer. I can give you the different permutations, right?
That would be perfect.
Some protocols are just looking for growth, so they'll take any business that they can get, and they won't charge anyone, and they're just using investor money, and eventually they'll either get enough growth that they can raise another fundraising round, or they'll just run out of money and die, right? That's model A. Model B is that you are charging either the asset issuer, or in some cases you're charging the chain, right? I think what we saw in recent years was the launch of many new chains, right? Both L2s and layer ones. And what does every chain want, right? They want to have a vibrant ecosystem of applications. And those chains were very well funded, and so had very large treasuries to deploy as one, economic incentives for building on their chain, but also as subsidies right, for infrastructure that projects might need to build on their chains. And this is not malicious, right? This is just how do you incentivize builders to build on your chain? Well, you lower the cost of entry, right? You lower these cost barriers, right, that a team might have to build somewhere. And so you ended up seeing chains paying for Oracle infrastructure, right, instead of the actual teams that were using them. Player who will not be named, right, started charging exorbitant fees to chains, right, to giving them the impression, right, that their chains would not be successful or not be seen as credible by builders if these chains didn't have this particular Oracle running on them. And when I say exorbitant, I mean in the tens of millions of dollars annually. Right. And so while I think that was very profitable for that chain, it's also not sustainable. Right. So going back to your question of like, what is the business model for Oracles, right? What is actually viable? That is, charging the chains a bunch of money is not, while profitable in the short term, is not actually viable in the long term. These chains aren't going to be able to subsidize their ecosystems forever, right? They're also susceptible to gravity. The chains won't be able to get really high valuations from VCs in the future either, as it becomes much more common. And we have a new chain as a dime a dozen. So I think largely that has subsided, or in the coming 6 months or so will subside. And we'll go back to a more bread and butter of, hey team, you want Oracle? Okay, you have to pay for it, right? And that leveling of the playing field, I think, is also very healthy.
Yeah, I have to imagine that what you described there sounds like a great dynamic for any Oracle provider that's able to charge the chain, because then you don't have to do the difficult work of selling to dozens and dozens of protocols, and you have one big buyer that's kind of subsidizing everything on their chain. But yes, but there are obviously long-term sort of ongoing challenges there. So just to kind of jump around a little bit here, as I mentioned at the beginning, you guys just raised $12 million in your most recent round. Congratulations on that, of course. And in all of the PR, something that is very clearly a focus for you guys is on real world assets, RWAs. Can you tell me how that became such a focus for Chronicle? Did it happen organically as a result of the work you did with Maker, or is this a very kind of targeted focus from early on?
So it's very much intentional. I think there's a very particular vision of DeFi and kind of how do we take it to the next level. And I think what we've been able to achieve in DeFi and, the volumes that we've been able to do, right, rivaling not just centralized exchanges, but even some traditional markets, right, the like open accessibility for people all over the world, right, that's been incredibly impressive. But we're still only at this certain level of scale, right? And we are not going to make that next jump, that next order of magnitude, trying to attract retail capital. It's going to come from institutional capital coming into DeFi. And that's going to come with a lot of baggage as well, right? I think this code is law, right? And there's no regulators, right? No licenses, no KYC. I certainly think those elements will remain in a subset of DeFi. But I think in terms of scale, the part of DeFi that starts to converge with traditional finance will very quickly outscale and dwarf, maybe even eclipse is the right word, right? That the kind of existing DeFi ecosystem. And so with Chronicle, I think rather than like shying away from that, I think we're leaning in and accepting that, well, this is the way things are going, right? And we're not giving up on pure DeFi, but the tokenization of assets is what's going to bring us into that trillions scale of liquidity, right? And the next step you have to ask yourself is like, well, what is kind of needed in that world, right? Or what is a catalyst that doesn't exist today that's needed for tokenized assets to be successful so we can get that level of liquidity in DeFi? And so I think that really is kind of this Oracle infrastructure. If you think of like the Ethereum token, right, or a Bitcoin, it's a crypto native asset. It was natively issued on chain. All of the properties of that particular Bitcoin or of all the Bitcoins that exist, you can find on chain. right? Like, you know who all the holders are, you know what the distribution is. With real world assets, with tokenized assets, you don't get these crypto native properties. And so this makes them incredibly difficult to integrate into kind of a DeFi ecosystem in a way that properly risk manages them and preserves a lot of these elements of transparency that DeFi kind of fostered that are incredibly helpful to have in a financial system, right? How many financial crises have we had because certain elements of risk were but natively tokenized assets don't have those. And I think this is kind of where an Oracle can perfectly step in to fill that gap. Because from a protocol perspective, it finally gives the protocol kind of omniscience over things that are outside of the chain, right? That are in meat space. And so with tokenized assets in particular, you want to be as close to the custodian of the assets as possible. You want to, as an Oracle, be able to give the real-time view of here is the private read access at the custody account, and this asset is on the books right at this very second, and being able to give that real-time attestation to the protocol so it can appropriately delegate or expand or restrict credit so it can purchase more tokenized assets, so it can redeem more or sell, right, more or less tokenized assets. It's really the ability of a protocol to be able to smartly handle these assets is really just limited by the data that an Oracle can feed. And that's really where we see kind of the future of Oracle's heading. I think people have like this misconception of like when they think Oracle, they're like, yeah, that thing that gives you like the price of something. And I think that's really misguided. Because I think with tokenized assets, the amount of data and the types of data that an Oracle will convey for a protocol to be able to handle that asset in a smarter and more native way is going to be extremely diverse. And that's really where we're positioning Chronicle, right? Is to be able to, one, be able to connect to all of these traditional financial systems where these assets are held, and two, being able to handle and interpolate all these interesting pieces of data that a protocol can then utilize to better integrate tokenized assets. And I think that's really what's going to unlock the next level of scale here.
Actually, just real quick, is it okay if you go over 10 more minutes or so? Do you have I know we're past
yeah,
the...
Sure.
Okay, perfect. So coming back to the note of RWAs for a second, I guess two things stand out to me in your answer of just sort of the everything you've just described. One is that, when you see this growth of RWAs going forward, do you imagine it's mostly going to be in the fungible asset category? So T-bills, gold bars, whatever it is, or do some of the same properties you're describing expand to less fungible types of off-chain assets? Like, for example, the type of credit that Centrifuge has worked on with MakerDAO in the past. Those deals obviously didn't go great. They were very small experiments at the same time. But do you think that there's something that you guys can provide to improve on the on-chain visibility into like off-chain credit assets? So not just T-bills and things of that nature.
So, I mean, I can't speak for Maker or Sky in terms of how they would like to develop their tokenization strategy in the future. So I'll kind of speak, my thoughts as Chronicle is kind of like where this is heading. I think there's room for both. There's room for both, and certainly we will see, more non-fungible, esoteric even approaches. That being said, I think the real growth is going to come from the fungible side. And one is that fungible side kind of already exists and is highly liquid. And we're really just kind of like almost like attaching an umbilical cord and like linking this already established market. But two, when it comes to these more fungible, like esoteric kind of investment opportunities, is that they are much smaller scale and actually require heaps more due diligence. And so when you think of a protocol like Maker or Aave or Compound, right, that extends credit, it doesn't scale, right? It's just too much work to do the due diligence to then underwrite this risk at a scale that is too small to make a difference to justify the original costs and the cost of credit. And so I think those were incredibly valuable learning opportunities that have influenced how Maker approaches tokenized assets today, and certainly for Centrifuge itself. And we will see more of them. But I'm 100% positive that the vast majority of the growth is going to come from fungible assets, right? Like treasury bills, like certain types of bonds, and even heavily leaning fixed income rather than equities.
Makes total sense. And I guess something else I caught in your initial answer, the second thing I mentioned, was that it almost sounds like, compared to some of the other pure play on-chain Oracle providers, you guys are maybe thinking about verticalizing a bit more, almost like up the stack of having, okay, you've got these off-chain asset issuers that want to come on chain. They need an Oracle provider as a way to do that. And so you're just kind of owning more of these customer relationships up and down the stack. Is that a good way to think about it as well?
Absolutely. Our ultimate vision is still that what we now consider as different layers of the stack, that we will see convergence there, right? And I think we'll eventually stop thinking about finance as traditional finance or decentralized finance, right? It's all just going to converge. I'm sorry, DeFi people, it's all just going to be finance. And all of a sudden finance will go back to, just being boring for, a bunch of people who have gray hair or no hair at all. Right. And all libertarianism that you attribute to, crypto will, every drop of that will have been wrung away, and we'll just have this husk of some coked up young 20s finance dude who's, working 100-hour weeks. Right. That's kind of doom and gloom. But look, this is where things are heading. Right. This is if you look at what is actually growing, what is actually receiving traction, what is actually achieving product market fit in crypto, right? It's DeFi and next to basically nothing. GameFi really has not played out, and several other, niche things like NFTs, right, are kind of nowhere as well, right? This is kind of it, but it doesn't come for free, right? That growth and that scale, it's going to come with some hairy kind of some hairy things to death.
Thank you for laying out that depressing future that we're headed towards. Maybe as we're kind of coming slightly close to the end here, to maybe wrap up the topic of RWAs a bit. I know you guys are very involved in the Spark Grand Prix that just happened, where Maker is going to be investing, I believe, at least $1 billion into a few different T-bill product issuers. What's the role that you guys are playing there? And I think something we kind of glossed over is, as it relates to RWAs, is your verified VAO, verified asset. I forgot the O, or Oracle,
Sure.
Obviously.
Yeah.
I would love to kind of hear how all that fits together.
Okay. Yeah, of course. So as you touched on, right, Maker just announced the winners of their Spark Tokenization Grand Prix. And what that essentially is Maker did a public tender, right, where they said, hey, we're going to commit $1 billion plus in credit into whatever tokenized asset opportunities you have. Hey, come pitch us, right? And you saw an outpouring of, I think, 40 plus different token issuers coming to the humble Maker forum to pitch their case for why their tokenized asset was the best one for Maker to allocate this capital to. And you saw it from big and small. You had people like BlackRock pitching in the Maker forum, right? Which is kind of incredible when you think about it, right? The world's largest asset manager coming to a little discourse forum to go pitch a DeFi protocol, right? Similar, you had the super states, the Centrifuge, you had Fidelity, right? You had M0, right? Some of the largest players in the tokenized asset space and also in the traditional financial space. And so last week, the winners of the Spark Tokenization Grand Prix were announced. Those were kind of BlackRock Securitize. They were Superstate, right, which is Robert Leshner's new crypto project, and Centrifuge, who has been in the tokenized asset game, right, longer than almost everyone. And so the role that Chronicle is playing with all of these issuers is that they're all using VAO. They're all using Chronicle's verified asset Oracle. And the VAO product, right, is essentially exactly what we talked about earlier, right? Is we are hooking up directly to the underlying assets to give this third-party unbiased view of what the assets are, what properties they have. So the Maker protocol, right, can appropriately manage that position in real time. And so this is not a new product, right? This is something that we've already battle tested with the launch of M0 earlier this summer, and that's been growing. I think M0 has been experiencing a tremendous amount of growth, but that product, is now operating at the scale of billions as well. I think it's incredibly cool that we now have two different products, right? We have like this DeFi core Oracle that is operating on the scale of tens of billions, and now this verified asset kind of tokenization Oracle, right, that is already operating on the scale of billions within, the first 6 months of its launch. So I think one, that points to a very successful product launch, but I think two, it's just going to help us rapidly iterate on growing that product further as we can point to, the largest tokenized asset issuers already using it for certain products.
Yeah, entirely. And I think especially in the context of Maker, that I think critics in the past would have said that some of the priority bill investments, I guess you could say, that Maker done maybe lacked a bit in the transparency category. And, the structures were, I think, suboptimal too. You had an SPV and just all of this confusing off-chain structuring. And now with the Grand Prix and what you guys are doing, it's a much clearer look into what it is that actually Maker is investing its funds into and earning essentially too. So I'm quite excited for that as someone who loves the DeFi side of these things. So as we're at the end here, I'm very curious. We've talked about what you guys are doing to kind of evolve the Oracle space. And I'm curious, as you look out over the next few years, what else you think will change or evolve within Oracles? Will we see consolidation? Are there other vectors of growth, technological improvements you're predicting? Tell us what the fortune cookie says here.
So, I mean, a few things. I think on the technology side, the underlying tech will probably change considerably. I don't necessarily think it's going to be, well, let me rephrase. Let me kind of like delve a little bit deeper. So up until now, everyone has been using validators for consensus, right? And remember, those validators solve these two very important problems of data integrity and censorship resistance. And they do it in a way that is incredibly scalable. Zero-knowledge proofs have kind of come onto the scene in the last few years. And while they've made a tremendous, and I mean like absolutely huge amounts of progress on being able to scale them, we're still not quite there where they are an effective from a cost mechanism, both to generate the proofs at the agility and frequency that an Oracle needs to be able to give a real-time attestation at the cost that a customer is willing to pay, plus, the business having some kind of margin. So we're not there yet, and it is still a technology problem. But at the rate at which ZK proofs are being improved, both on the prover and the solver side, on the scalability improvements that we're seeing from chains, and as the cost of hardware should come down, right, to make it more affordable to generate proofs, we will reach this inflection point where you can just chuck out the validator component completely and just replace it with pure cryptography. Now that's very cool from a data integrity point of view. You're still going to have the censorship resistance kind of problem that you have to deal with, right? And there's certainly a variety of ways to look at that, right? And you can reinvent validators and just say, hey, you need multiple people that are generating proofs, right? And now you've kind of reinvented the wheel for no reason at all, right? You can say that, hey, anyone can deliver me a proof, and here is a bounty if you do deliver said proof, right? So now there's an incentive for someone to show up, right? And you know that they can't have done anything malicious because the proof will ensure the data integrity guarantees. So I do think that is coming, but it's not there yet, and where it can be used, at scale in a sustainable manner. But that is going to happen within the next, I would say, 12 to 24 months.
Yeah, I have to imagine too that even for the business of an Oracle provider, that is good for the business of Chronicle as well, as I imagine, cost that or revenue that gets passed along to validators is a fairly large kind of cost that's not otherwise going to you. So that sounds quite promising.
Well, you can imagine why we haven't switched yet. It's because the cost of the validators is actually less than the cost of the proof, right?
Interesting.
That's the stage that like the problem domain here.
Right? I see. Huh. Well, I'm sure that could be a whole kind of other episode in itself digging into that. But as we're kind of at the end here, something I'd be remiss not to ask is I believe you guys have a points campaign running right now. I actually don't know too much about it, so I'd love to hear from you and how people can get involved.
Absolutely. Yeah. So we partnered with Maker, or now known as like Sky Protocol, right? Who is the exclusive partner and like arbiter of Chronicle points. And so I think what people might be familiar with is you can stake your DAI, right? And staking DAI earns you kind of this DAI savings rate, right? And this was always one of like the best parts of DAI was like that you could earn, a native yield. Well, now you have like one extra option, and essentially instead of selecting earning kind of the DAI savings rate, you can select to get your earnings in Chronicle points. And so this is the only way to get Chronicle points, and the points will convert into an airdrop at TGE. And the participants in this points program are going to be the only people that will have liquid kind of unlocked tokens at launch. And so I think it's like a really exciting opportunity, and also a way for people to kind of get in early, and not have to pay these evil inflated VC prices or something. Democratize access and give everybody a chance, I think is kind of the motto here.
Yeah, I have to say that was probably a tougher sell when the Sky savings rate was like 11 or 12%. But now that that's come down to 4.5 or whatever, I think staking for Chronicle points seems very underrated.
Absolutely. And
I'll
and Brian,
reallocate some of my funds.
there's no like risk here in the sense, your DAI is not being rehypothecated into something else or being lent out or whatever. No, it's just sitting there, like waiting for you to like withdraw it whenever you want, right? And you still keep all the points that you've earned until then.
Well, I'm gonna have to reallocate some of my funds after this call. Looking forward to that.
Cool, awesome,
Nik. Yeah, thanks for all the time today. Thanks for coming on the pod. Thanks for talking to us about oracles, and where can people learn more about you, about Chronicle, the points program? Where should they go?
chroniclelabs.org.
Great.
Super simple. Find all the info there.
Awesome. All right. Thanks again. And thanks everybody for listening.
Yeah. Thanks so much for having me.